Markets opening up strong this morning on the equity side, not so much on the oil and commodity side. What's going on there? We'll talk about it on 3 minutes on Markets and Money. Yesterday, oil prices spiked early on expectations of Russian sanctions. Well, that actually came to be the case, and oil actually started selling off this morning. Oil futures are down a couple of percent this morning, pushing oil back lower. Of course, not surprising here, just from a technical basis, as we talked about yesterday, oil had gotten more than 3 standard deviations oversold, just extremely extended, which suggests that prices are going to have a correction here at some point. And in fact, we could see oil prices correct all the way back down towards $100 a barrel. That would certainly not be surprising. That would simply just be a retest of the rising 50-day moving average, which could set oil prices then to go higher on the next rally if the situation in Russia and shortages of oil supplies continue. Our expectation, though, is that high prices tend to fix high prices, which we are seeing supply start to come up in terms of drillers. Supply will rise, of course. Higher prices start to crimp demand, slows down economic growth. That reduces demand, that allows supplies to catch up. That brings prices down as well. So have we seen the peak in oil prices? Maybe, maybe not yet. But very likely we are getting close to the point that at least we're going to have a short-term correction in oil prices in order to allow oil prices to rise further if that is indeed going to be the case. Gold looks very much the same way. Commodities always tend to kind of run together, and yesterday, as we discussed, gold had gotten more than 3 standard deviations, again, like oil, above the 50-day moving average. Gold prices beginning to correct here. Again, a pullback to $1,915 an ounce on gold would not be surprising. That'd just be a retest of the 50-day moving average. Again, that would allow prices to then rally back towards these recent highs. Again, well within the context of what you would expect technically for a position that is as overbought and extended as gold, really commodities in general, are across the board. Now, as opposed to that, equities actually looking a lot better. As we wrote about in this morning's daily market commentary, kind of expect this market to give us a good rally. Futures now up this morning about 535 points on the Dow. The NASDAQ up over 200 points this morning. Between the January-October lows that we've continued to hold here and this declining trend line of the 20-day moving average, we are building a very tight consolidation in market. So a break to the upside could be fairly strong. So if we get a break above the 20-day moving average, we could see a fairly strong follow-through. That could occur next week if the Federal Reserve becomes more dovish than expected on monetary stance, or we get some more good news out of Russia, Ukraine. Again, more talks here. Zelensky saying now that, being part of NATO isn't as important as it was previously. That could alleviate some of the pressure here, allowing a better upside advance in markets, which, again, we've got an oversold condition of the markets that provides that fuel along with very negative sentiment, negative positioning, as opposed to commodities, which are overbought, extended, and overdone. Stocks actually setting up here for a very nice counter trend rally. So we could see money flow from the commodity trade back into the growth trade here, at least on the short term. So don't miss out on being too one-sided in your market bets. I'm your host, Lance Roberts, for 3 minutes on Markets and Money. See you back here tomorrow.